Hey, everybody. Welcome back to the What the Wealthy Do podcast, where we pull back the curtain on how the wealthy build their wealth and show you how to apply those same strategies to your everyday life. I am your host, Stephanie Dorsey. I am also the CEO and co-founder of Margins Capital, where we provide access to women and people of color to an institutional quality portfolio of alternative investments. We are finally talking about my absolute favorite topic, which is alternative investments or private capital markets. This space is why the wealthy are continuing to leave us in the dust. This is why the wealth gap is continuing to widen. It's because 81% or 4 out of 5 ultra high net worth individuals invest at least half of their wealth, or about 46% of their wealth, in alternatives. This is their moneymaker. This is the reason. It really, really is. And this is the thing. This is the hill I will die on. And I'm trying to make sure everyone is adequately informed about this massive wealth generating ecosystem of assets. And I want to help everyone find a way to incorporate some of these assets, or at least a sliver of their portfolio. I want you to allocate to alternative investments or private capital markets. So that is what we're going to be talking about today. Frankly, we're going to be talking about what the wealthy have always known. So it's really hard to create massive wealth and massive gains in the stock market when you're just starting out. There are two things I want to remind you. One, again, this podcast is all about providing financial education and not financial advice. And then two, in this particular episode, I am going to be referencing different charts and different visuals. And so if you're the type of person that likes to see those visuals, perhaps you would like to watch this podcast on YouTube. But if you don't care, feel free to listen to the podcast on Apple or Spotify, whatever makes sense for you. All right, let's get into it. So private capital markets versus public capital markets. So public capital markets, as a refresher, these are anything that everyone has access to via the stock market or a stock exchange. So that means you can go on Robinhood, you can go on Charles Schwab, you can open up an E-Trade account, and you can trade anybody, regardless of your investor status. If you're new, if you're an accredited investor or not, you can have access to these markets. Alternatively, the private capital markets is just that. They're private, right? A very, very simple example is real estate. It's a one-to-one transaction-ish. I mean, it could be institution to institution, but you have to be invited to play, right? Even if, for instance, when I sold my mother's house, you couldn't get access to that on the stock exchange. Right? You have to come and find me directly to get access to it. So that's an example of a private exchange or a private investment in the private capital markets. So there are two main reasons why the wealthy are deciding to invest in the private capital markets and not just put all of their eggs in the public capital market space. And that's because, one, diversification. You will see, and I will show you that while the public capital markets are massive, right? The public stock exchange, I mean, it's worth over $100 trillion in the US. It's not as diversified as you think it is. And then the second reason why wealthy folks invest in the private capital markets is because there is more of a chance obtaining outsized returns. Yeah, full stop. Right? And I'm gonna prove both of those things to you. Before we get started, I just want to show, yes, the private capital markets is much smaller than public capital markets, which is crazy. But they also don't use the same metric to measure them because you can't. So the metric that's used to measure the size of the public capital markets is called market capitalization. So there, all of this information is public. So it's easy to take all the stocks that are offered on the stock exchange. You multiply that by the price of those stocks. And that's how you get to a number of around $67 or so trillion if you only look at the stock market itself. Unfortunately, you can't use that same metric to evaluate the size of the private capital markets because there is no source of truth with figuring out all of these different companies and how much they're charging for a stock. There's no source of truth because there aren't reporting requirements. There is no public marketplace, if you will, for these private companies. So Stripe, that is worth about, last time I checked, it was somewhere around $65 billion. There is no public record or no way to determine just how many stocks or shares of equity that they're offering with a price by it. And so if you can't figure it out for Stripe, like, you're not going to be able to figure it out for Anthropic or OpenAI or SpaceX, or, you know what I mean? Because there isn't a daily marker of these are the number of shares and this is their price. So the best way that we can use to evaluate the size of private capital markets is by measuring how much money is out there set aside to be invested in the private capital markets. So that number is called assets under management. And when you look at assets under management, we're somewhere around $14 trillion in the US. Applies to all different asset classes. So that's commercial real estate, that's your private equity, and your venture capital, which is going to look at companies, but it's also infrastructure deals. It's also movies and things of that nature. So it's just really hard to measure. It's not apples to apples when I tell you the size of the public markets is 67 trillion and the size of the private markets in the US is somewhere around $14 trillion. But again, we seem to like $1 trillion is a lot of money, right? Let me give you a little bit of perspective. So if, for instance, the private markets is worth about, in the US, is worth somewhere in the $14 trillion range. Let me give you perspective in terms of the gross domestic product for the top 3 countries in the world. And so gross domestic product values all of the goods and services that are offered in a given country, right? And as you could imagine, the United States is number 1. And our expected GDP for 2025 is somewhere around $30 trillion. It's crazy. It's massive. It's big, right? The second country is China. And their GDP is just over $19 trillion. So it's big. But think of that. 19 trillion, 14 trillion in terms of the size of private capital markets in the United States. The third country on this list is Germany, and their GDP is $4.75 trillion. So think about that. So the value of all the goods and services for the third largest country is $4.75 trillion, which is roughly a third of the private capital markets in the United States. So I just want to make sure that we understand that, this is private capital markets is so much smaller than the public stock market, but it's still massive in the world. Right? Like, it's massive. So I just want to make sure you recognize that. Okay, so we talked about, again, diversification is a main reason why the wealthy invest in alternative assets. And so let's talk about that. When we talk about the US stock exchange, a lot of folks are just like, yeah, but I could just get the S&P 500 is massive. I can just invest in the index fund and I'm already diversified. We're great. It is good to go. However, what's crazy is when you think about the S&P 500 represents the top 500 largest or most valuable companies in the United States. But so the Magnificent seven of those companies, that's Alphabet or Google, Amazon, Apple, Microsoft, Nvidia, Meta, and Tesla, they represent over a third in terms of market capitalization. So when you think about how much value they're worth in terms of how many stocks they're offering and the price, they represent a third of the top 500 of the S&P 500 in terms of market capitalization. So I'm going to say that again. 7 of the 500 companies represent a third of the value that's created by those 500 companies. So just 7. So when you invest in an index fund that represents the S&P 500, know that a third of that $100 you put in is represented by 7 companies. So it is not as diversified as you think it is, because these 7 companies represent so much of the value in our stock exchange. Another thing that makes it really difficult to get all your diversification from the public capital markets is that the number of companies that are going public is shrinking. There just aren't. There are more companies that are staying private instead of going public. And this chart that you see here shows that the number of companies in terms of value is the number of private companies is outpacing the number of companies that are going public. And so you have all of these companies that are growing and getting bigger. I referenced Stripe that's being worth $65 billion. They're private and they're staying private longer. And these companies are staying private because basically in order to go public, the SEC requires a lot of compliance and reporting, as well as your shareholders are now you and me. Like the company shareholders are you and me, and they have a fiduciary duty to us. Our random Stephanie in Delaware, they're like, girl, I don't even know her, right? Versus if you stay private, then you have more control over what investors are on your, it's called a capital table or cap table. You know exactly who have access to your company and who have access to invest in your company, and you get to decide, you kind of get to gatekeep, frankly. So another reason why companies are staying private longer, other than the reporting requirements, is the access to capital. There was a time when you absolutely had to go public in order to get access to massive amounts of capital, right? So you really needed to sell shares to the public to get hundreds and hundreds of millions or billions of dollars of capital to fund your massive growth. But now you have the Blackstones or Apollo Groups, and you have these really large venture capital funds, as well as private equity funds and even private credit funds. You can get access to capital without having to open a kimono, so to speak, by going public. So as I showed you before, the number of private companies, the private markets is growing faster than the public markets. And so what that leads us with is this crazy statistic that everyone should know. And the statistic is, out of all the companies in the United States that earn $100 million or more, 87% of them are private companies. So we only think about the Coca-Colas, the Walmarts. We're brainwashed to think that these name brand companies that we've all heard of, that are probably 20, 30, let's say 30, or let's say 50 brands that we've all heard of. Well, there are like 3,000 or so stocks on the New York Stock Exchange, right? So there's like 3,000 or so companies. And a lot of them are doing really well. In fact, the number is somewhere around 2,800 or so of these public companies that are on this public stock exchange make about $100 million a year. And again, we can probably rattle off 50, but there are a lot that we can't rattle off. And so that's great. 2,800. That's awesome, right? But that's only 13% of all the companies in the US that earn $100 million or more. So there's 18,000 or so private companies that are generating those type of revenues. And so when you think about all of those private companies that are that big, 6 times as many that are private than are public, like the opportunity to create outsized value is clearly in the private markets and not in the public markets. Now, I'm sure you're probably thinking, like, what you just said, it don't make sense, because you already told me that the size of the public markets is so much bigger than probably less than 6. So it's about 5 times as bigger as the private markets. Yes, the size of the market capitalization, not the number of companies. So the number of companies is bigger. So you have a lot more $100 million companies that are in the private markets than are in the public markets. But you have these crazy big brands. Apple, I already told you the Magnificent Seven is worth a third of that. Their market cap is somewhere around $20 trillion. 7 companies worth about $20 trillion. And then you have the rest that worth the rest of that 45 or so trillion dollars that are we got 2,800 companies that are worth the rest of that $45 trillion. So that's how the math works. There's value and then there's sheer number of companies. And so in terms of sheer number of companies, the private markets take it. But in terms of value, how massively valued a company is, and we're talking about cumulative value, so all of them put together, then the public markets take it. But here's something to think about. When the Titanic the man said, iceberg, iceberg. It's really hard to shift the Titanic. It's really, really difficult to move it on a dime. You can't. So when you think about these public capital markets and you have these massive, massive companies like Walmart and Nvidia and Apple and all of that, it's really difficult for them to create 10x, 20x type of returns. Nvidia, again, it is an outlier. So one last tidbit for you to know is historically, the last couple of years, the public stock market has been on an absolute tear. But if you look at how private equity has outperformed the US stock market for the last 15 or so years, and that doesn't mean that, and you will be hard pressed to find any finance leader, even the heads of JP Morgan, Jamie Dimon, the head of Blackstone, the head of BlackRock, no one is going to say that you should take all your money out of stocks and put them in the private market. What they are going to say is that you should allocate anywhere between 10 to 30%, depending on who you are, what your financial goals are, what your risk tolerance is. You should allocate some of your dollars to the private capital markets for added diversification as well as the opportunity for outsized returns. So I hope this proved to you why you should care about private capital markets. All right, private capital markets are growing faster than the public capital markets. The private capital markets offer more opportunity for outsized returns as well as added diversification because the public capital market, the third of the market capitalization is concentrated in just a handful, literally a handful of, frankly, tech companies. And this is why ultra high net worth individuals, the vast majority of them invest almost half of their wealth in the private capital market space. So hopefully I have proved my point and you will stay on this journey with me to learn and continue to learn about private capital markets. And we are starting a series of different asset classes or different types of assets that make up the private capital markets ecosystem. And if you found this episode to be helpful, please forward it to a friend. Don't forget to like and subscribe on wherever you decide to get your podcast, on YouTube, Spotify, or Apple Podcast. And we look forward to seeing you next week. Bye.